Welcome back. Today, I want to step back from the aviation specifics for a moment and talk about financial mechanics. Because one of the most important things I can do for an investor who's new to this space is help them understand where aviation infrastructure sits in the investment universe, what it looks like compared to things they already own and understand. The first comparison is conventional real estate. Aviation infrastructure shares a lot of surface characteristics with industrial real estate, long-term leases, physical assets with clear replacement cost floors, location-dependent value, and tenant relationships that are often deeply embedded. But there are a few critical differences that make aviation infrastructure more attractive. First, tenant retention. Industrial tenants can and do move when leases expire. A manufacturer might relocate to a cheaper market. A logistics company might optimize its network. Aviation tenants don't move. Moving a corporate flight department from one airport to another is an operational project that takes months and costs significantly in disruption. The retention dynamics are fundamentally different. Second, supply control. In most industrial real estate markets, a developer can buy land adjacent to an existing facility and build a competing product. You cannot do that at an airport. The airport boundary is fixed. The FAA governs what can be built and where. The airport authority controls who gets leases and on what terms. Supply is structurally constrained in ways that no conventional real estate market can match. Third, pricing power. Industrial real estate has experienced good rent growth in recent years, driven by e-commerce and reshoring. But 11 to 19% annually, that's not a number industrial landlords are posting. The combination of better retention, better supply control, and better pricing power makes aviation infrastructure a superior version of the industrial real estate investment at a valuation that still reflects the early stage of institutional adoption. The second comparison is traditional infrastructure: toll roads, utilities, ports, pipelines. Aviation infrastructure shares the essential service character, non-substitutable, serving a captive customer base with regulatory barriers to competition. But traditional infrastructure investments typically require very large check sizes, billions of dollars for a mature toll road concession or port terminal, and they offer limited upside beyond the contractual cash flows. They're essentially bond-like in their return profile. Aviation infrastructure, by contrast, is available at a scale appropriate for mid-market funds, offers an operating business value creation layer that mature infrastructure lacks, and it sits at an earlier point in its institutional adoption curve where entry valuations still reflect discovery risk premium. The third comparison is private equity. PE offers the value creation potential and the operating leverage that aviation infrastructure also has, but PE is exposed to corporate fundamentals, the performance of the underlying operating businesses in its portfolio, in ways that are genuinely cyclical. A business aviation infrastructure platform has something that pure PE doesn't: a real asset foundation that provides a floor on value regardless of operating performance. The land, the building, the ground lease, these have value even in a stress scenario. The real asset backing gives aviation infrastructure a downside protection profile that pure operating company PE lacks. So where does that put aviation infrastructure? It's at the intersection of the three conventional categories. It's real estate in its physical character and lease structure, infrastructure in its essential service positioning and regulatory moat, and private equity in its operating leverage and value creation potential. That intersection is exactly where the best risk-adjusted returns tend to be found, in asset classes that don't fit neatly into existing categories, that haven't yet been fully discovered by institutional capital, and that reward early entrants with a combination of current yield and capital appreciation that the conventional categories don't offer simultaneously. That's aviation infrastructure today.